Now I am going to talk about a concept called sound finance or the balanced budget approach. According to the classical economists, however, fiscal policy should have a minimum range of operations and the budget should be balanced annually. They firmly stuck to the doctrine of laissez-faire and Say's law of market. As such, they believed that when supply creates its own demand, general overproduction or involuntary unemployment is well nigh impossible. That is almost impossible. According to Adam Smith, economic equilibrium and progress are attained through inherent and self-oriented endogenous forces of the economic system. In classical opinion, thus, when full employment is supposed to reach automatically, productivity of government services in the economic field is nil. Thus, when the government's productivity is zero in a free enterprises economy, it is desirable that the government confines itself only to its primary functions of protection, security of life and property, and does not interfere with the free working of the economic system. Even if government efforts are productive, it cannot increase national income and level of economic activity above the level reached without its intervention. Thus, when full employment, optimal allocation of resources or equitable distribution can be achieved automatically through the operation of free economic forces, physical operation has to be of a non-regulatory, non-interfering nature. As such, the smallest budget was considered to be the best in the classical era. Further, the classicals condemned all budget deficit which necessitated borrowing by the government, for they led to inflation, and even if they did not, they caused reduction in the accumulation of private capital because the resources in the private hands were depleted due to the government borrowing, thus inhibiting the rate of progress. As such, classes firmly advocated a balanced budget in the sense that current annual revenue and expenses of the government must be equal. It thus does not provide for borrowing. A balanced budget principle was thus recognized as a principle of sound finance in the orthodox economics. Under the theory of sound finance, classists favored a balanced budget criterion for the following reason. If a budget is balanced, the government has to borrow. The government's market borrowing causes reduction in the loanable fund available to private productive employment and investment activities. Unbalanced budget imply a wide extension of state functions beyond the capacity of the government, which may invite irresponsible governmental action. Unbalanced budget may generate inflation on account of large and unproductive public expenditure. A balanced budget, on the other hand, is a limited budget designed in a rational way. Economic stability is secured by the adoption of a balanced budget policy. Unbalanced budgets, on the other hand, causes economic uncertainty and promote instability. A series of unbalanced budget imply an increase in the burden of public debt. These are the things that classical economists favored in terms of following a balanced budget criterion. Furthermore, when the public debt mature, the government will have to impose additional taxes to obtain resources for the repayment. Thus, additional taxation would again tend to have an adverse effect on the incentive to work and save. It would also cause the accentuation of income distribution. Moreover, government borrowing caused the rate of interest in the money market to rise as the demand for loanable fund rises. A rise in the rate of interest adversely affects investment activity in the private sector. In short, according to the principle of sound finance, a budget must be balanced annually and the gap between revenue and expenditure should be the minimum. This is a government should tax the least and spend the least, and it should not resort to borrowing as far as possible. Thus, the classical economists firmly advocated a laissez-faire policy and were confident of the unhampered optimum operation of the free enterprises economic system. New classical economists, however, realized the socially undesirable effect of unregulated free enterprises on the economic system. Marshall stated that in conditions of laissez-faire, maximum social advantage is hardly realized. It was argued that careful state action for raising income and public spending was essential to attain maximum social welfare under the concept of welfare state developed into the new classical era. Under the welfare state criterion, it was accepted that the state should take up responsibility for correcting the misallocation of resources guided by private profit motive. The state has therefore to discourage private investment in certain sectors of the economy through physical restrictions and encourage private as well as public investment in essential sectors through appropriate public spending. Pigou and Marshall in this regard favored equal marginal social sacrifice and benefit as essential in the government budget. Thank you.